the silver price in China, premium's still there. I think it's still trading around 100 now. It flooded the market with paper shorts. Took the market down to like 73 from like almost 100 in a matter of minutes. And it's crazy, and it scares people off.
David Substack, he said, what the CME COMEX calls dynamic circuit breakers automatically kick in when the price of silver drops or rises by 10% on a rolling 1-hour basis. We can see that from 12:30 to 1:30 Eastern Time PM, the price of silver, both cash spot and futures, ranged between $91 and $75, representing an 18% range, and yet the CME COMEX automatic circuit breakers were not activated.
It's a psyop, really. Yeah, the bankers and the politicians are in bed together, and I don't trust them, so I'm holding on to my gold and silver. The Chinese market, Shanghai Gold or Futures Exchange, they used the circuit breakers today to halt because silver went down quite a bit. So they're doing their job. Keep cool, don't get too cocky. And
what on earth is going on with silver at the moment?
Well, not much really, at least not my silver coin. It's still a silver dollar. I think it's just a lot of shenanigans in the COMEX and over-the-counter foreign exchange market based in New York and London. And that's what it's about. And on Friday, yes, silver came off like early in the day, London time, down to like 95, I think, and then it rebounded a little bit. And then after the physical market in London kind of closed, after like 3:30 p.m. London or 10:30 a.m. New York time, the bullion banks, and whoever came in and flooded the market with paper shorts, and that took the market down to like 73 from like almost 100 in a matter of minutes, and it's crazy, and it scares people off. And I think, of course, silver had rallied strongly from like the end of December till Thursday. It made a high at 121. We were down in the low 70s at the end of last year. So yeah, it needed a correction, but I think it was used by the usual suspects to accentuate it even more, to try to scare off the people that are going on to COMEX and buying like contracts, for example, January contracts, which was in the front month.
This wasn't volatility. It was a timing exercise designed to hit confidence, not price discovery. As Mario Innecco has pointed out, sharp moves after physical market closes often reveal who actually controls liquidity. An intraday drop from near 100 to the low 70s isn't healthy correction territory. It's a paper-driven shock meant to flush leverage and sentiment. When silver rallies from the low 70s to 121 in weeks, corrections are normal, but minutes-long collapses are structural tells. For investors, this matters because price signals are being distorted, not invalidated. Mario Innecco highlights why these moves often precede renewed accumulation, not long-term tops. Watch what happens after fear peaks.
They bought almost 10,000. Well, they bought 10,000. They took almost 10,000 contracts of delivery, which is 50 million ounces, which is unheard of for a January contract. And I see that in February, they're already doing the same. They've already asked for over 2,000 contracts in delivery the first 2 days of February. And what the bullion banks, I think, are trying to do is discourage these people by, creating an artificial price so that they'll stop trying to clear out the COMEX of its registered silver inventory, and the LBMA for that matter as well. And we've noticed as well, Jesse, that the silver price in China is still, the premium's still there. I think it's still trading around 100 now. It has come off, of course, but big discrepancy. So I think that's what's going on. Unfortunately, it's going to discourage a lot of people to get involved, and maybe even the people who got in late, who thought it was a good thing to do. Even people who are just buying physical, they're getting out. I think a lot of people are concerned that this is like 1980 and 2011, and silver's going to drop, and we're never going to see it go back up again. I'm holding to my guns, and I believe we're going a lot higher because the fundamentals haven't changed.
50 million ounces standing for delivery is not retail panic. It's institutional intent. Mario Innecco has noted that January delivery volumes of this size are historically abnormal and stress-registered inventories. When China trades near 100, while Western paper markets collapse, that's a pricing bifurcation, not coincidence. The discouragement strategy works psychologically, but fundamentals don't reset overnight. Physical demand remains intact, while paper price weakens, a classic divergence investors should respect. Those exiting now are reacting to optics, not supply mechanics. As Mario Innecco emphasizes, price weakness, alongside strong delivery, is often where long-term positioning quietly begins. The next phase depends on who controls the metal, not the screen.
If anything, things are getting worse, geopolitically, economically, socially. I mean, there's so much mess going on, not just in the US, but also in Canada, in the UK. The whole of the West is like, seems to be crumbling apart. And yeah, I don't trust the people in charge, the politicians nor the bankers, because the bankers seem to be in charge. Jesse, I saw a story in the FT that one of the guys in that list, I don't like to use the name of the list, but everyone knows the list I'm talking about that's just come out. Well, there was a minister in the UK. He became ambassador to the US last year. He's had to resign. He resigned months ago from that because he was in that list. And back in 2009, he was giving information to JP Morgan about UK policy before anyone knew about it. So yeah, the bankers and the politicians are in bed together, and I don't trust them. So I'm holding on to my gold and silver. Probably, hopefully, try to get some more, if anything. So that's how I see this these last couple of days. And I've said to viewers in the past of my channel that you need to be even keel, have an even keel.
This isn't just about metals. It's about institutional trust erosion. Mario Innecco has warned that political financial entanglement is a systemic risk, not a headline scandal. When policy leaks favor banks before the public, markets stop being neutral allocators of capital. That's why hard assets re-enter portfolios during governance stress, even when prices swing. For investors, gold and silver become risk management tools, not speculation. Staying even keel matters because emotional exits usually benefit insiders with time and information advantages. Mario Innecco's takeaway is clear. Volatility punishes impatience, not conviction. The next section reveals how policy mechanics reinforce this imbalance.
You know, when gold and silver are going up like they have, keep cool. Don't get too cocky. And then the same thing now. It's a psyop, really. They don't want the general public to be financially independent, and they do that. They don't care, and also they're trying to cover them, their financial situation because they have huge short positions in paper, and if anything, this has probably exacerbated it. And I don't think the big institutional, even central bank buyers are going to stop. They don't care about a little correction in silver. They're going to come back and try to get more physical. I saw that President Trump just announced a $12 billion fund to secure rare minerals. I mean, so yeah, silver's part of that, and so I think it's yeah, the wrong time to get out.
Very great summary. We are going to get into the list a little bit later because I think everything is connected here when it comes to the monetary system and these people who are in charge pulling the levers of power. But I want to get back to last week, Friday, because from what I understand, and David Jensen wrote about this recently, circuit breakers should have kicked in at the CME COMEX.
When circuit breakers fail to trigger, the issue isn't volatility, it's enforcement. Mario Innecco has flagged that unchecked paper short exposure amplifies downside while insulating institutions. Central banks and sovereign buyers don't respond to intraday noise. They respond to strategic supply and national security priorities, like rare minerals funding. That's why pullbacks rarely stop physical accumulation cycles. For investors, the risk isn't missing the exit. It's mistaking structural demand for speculative excess. The silence around circuit breaker failures is itself information. As Mario Innecco stresses, when rules bend quietly, markets are signaling stress, not stability. What follows exposes how deep that stress runs.
When silver dropped so dramatically in such a short amount of time, I want to read a quote from David Substack. He said, "What the CME COMEX calls dynamic circuit breakers automatically kick in when the price of silver drops or rises by 10% on a rolling 1-hour basis. We can see that from 12:30 to 1:30 Eastern Time PM, the price of silver, both cash spot and futures, ranged between $91 and $75, representing an 18% range, and yet the CME COMEX automatic circuit breakers were not activated nor announced by the CME." So if what David alleges here is true, this could indicate that the exchange is heavily complicit in this sort of price suppression. Is that how you see things?
Yeah, I mean they've been doing it for decades. They they did the same with the Hunt brothers. They always favor the big banks and the big dealers. And do you remember? I think it was Boxing Day, which is December 26th. I think silver was up like 10 cents, more than 10%. And they came out and then they closed the market for like 6 hours. It wasn't even a circuit breaker. And they used this excuse of this data center that there was a glitch or something. But yeah, Friday, nothing, right? Was down more than 10%.
This is where market rules quietly turn optional when powerful interests are on the wrong side. As Mario Innecco points out, an 18% intraday range should have mechanically halted trading, not slipped through unnoticed. Circuit breakers triggering on rallies but vanishing on crashes exposes a one-way enforcement problem. Historically, similar exceptions during the Hunt brothers era protected dealers, not price integrity. For investors, this signals that downside risk is being accelerated artificially while upside is capped administratively. Liquidity didn't disappear, oversight did. As he warns, when safeguards fail selectively, price becomes policy, not discovery.
I saw a headline today on X that one of the Chinese markets, I don't know if it was the Shanghai Gold or Futures Exchange, they used the circuit breakers today to halt because silver went down quite a bit. So they're doing their job. But yeah, they will do whatever it takes to help the bankers, because the bankers really are in charge. I mean, the COMEX CME, it's now a public company. It used to be owned by the people who traded in the exchange. You could be a partner. You could have gone and bought, a seat on the COMEX, but now it's owned all by the big financial institutions like BlackRock and others. I haven't looked exactly, but they're going to favor, they're going to favor these people. And if they're in trouble, they're going to play dirty. They played dirty back in 2021. In the first silver squeeze movement. I mean, the head of the CFTC, even said, "Oh, we had to tamp down the price of silver." I mean, for the regulator to say that. So yeah, no, David Jensen is right, and I think even today they didn't use it.
This contrast between exchanges tells you where price protection actually exists. Mario Innecco has highlighted that Chinese exchanges halt volatility to preserve market order, while Western venues prioritize counterparties. Once CME became institution-owned, its incentives shifted from fair access to balance sheet protection. The 2021 silver squeeze confirmed this when regulators openly admitted suppressing price. For investors, this means Western paper markets carry structural bias against sustained upside. Risk isn't volatility, it's asymmetry. As he notes, markets that protect insiders eventually lose relevance when capital migrates elsewhere.
I mean, we were down quite a bit earlier, and I didn't see the market stopping. Maybe it did, but yeah, they'll. I think, Jesse, what this shows is that they're really desperate, and but I don't think it's going to work because we're not in 1980 anymore. We're in 2026, and there's a lot more interest in silver and a lot more exchanges where people could move to buy real physical silver and gold. COMEX and LBMA, if they keep up with their shenanigans, there'll be history.
Desperation shows up when control weakens, not when it's secure. As Mario Innecco explains, today's silver market is fragmented across multiple physical venues, unlike the centralized structure of 1980. Capital mobility is higher, information is faster, and suppression leaks are visible in real time. When price drops fail to stop demand, it signals diminishing effectiveness. For investors, this reduces long-term counterparty risk and shifts leverage toward physical ownership. Market power no longer resides in one exchange. As he emphasizes, fragmentation is the enemy of price control, and that trend is accelerating.
Let's talk about gold specifically for a moment here, because also falling quite hard, but only 9% as opposed to silver's massive drop. Currently on the day, we're down around 4.5%, so we're around $4,600 an ounce. So if we compare gold's drop to that of silver, do you think gold could perhaps recover faster given central bank buying and all the other tailwinds around gold kind of being reintroduced to the monetary system? Not obviously as a gold-backed currency or anything, but we're just seeing its importance in terms of central bank buying, Basel III, and all of the government debt and deficits. Gold's role as money seems to be shining more than ever. Do you think that will help it more than silver when it comes to recovering from this correction?
Actually, I don't. I think silver is really on it's a different kind of energy now. Silver after we broke 50, and so I think when silver recovers, it's gonna really motor ahead. Not that gold won't either, but I think yeah, when things pick up again, silver will do even better. So
Gold's smaller drop looks comforting on the surface, but that calm may be hiding a very different risk profile underneath. As Mario Innecco has pointed out, central bank buying has cushioned gold's downside, yet it has also crowded positioning into a trade institutions already control. Gold being down roughly 9% versus silver's much sharper move reflects defensive capital, not necessarily future upside leadership. Basel III, rules and record sovereign debt levels support gold's monetary role, but they also make its price more policy managed than markets admit. Silver, after breaking above 50, behaves less like a reserve asset and more like a liquidity pressure valve, which can snap back violently. Watch how this divergence challenges investor assumptions, because as he warns next, safety can sometimes lag opportunity when cycles turn.
I do want to go back to your comment about this isn't 1980 anymore, because it does bring to mind the recent price action, the hockey stick parabolic rise, the dramatic fall on the other side. I'm sure many are thinking the same thing that I am, that it kind of looks similar to 1980 and 2011. If we look back, though, and adjust the 1980 high to today's prices, we have not yet retraced that level, which is a little over $200 US, I believe. what are your thoughts there? Because obviously the narrative out there and all of the evidence you've presented and people like David Jensen when it comes to the COMEX and the price suppression is very real. But the even if it is real, sometimes the narrative doesn't get reflected in the price of an asset. So why do you think that this time we're going to be able to recover as opposed to staying flat for decades as happened after the 1980 high?
Yeah, well, a lot of people show the long-term charts, or they don't even show charts. They just say, "Oh, in 1980 it reached that high, in 2011, and then it dropped." But if you look at a really long-term chart of gold, for example, from 1970 till now, and logarithmic, because a lot of times they show these like normal charts.
Surface level chart comparisons ignore inflation, scale, and structure. Mario Innecco points out that inflation-adjusted highs matter more than nominal peaks, and silver hasn't reached them yet. Linear charts exaggerate bubbles while hiding long accumulation phases. Unlike post-1980, today's debt levels, currency competition, and reserve diversification change the backdrop entirely. For investors, the risk isn't another decade of flat prices. It's misreading timeframes. Narratives lack structure. As he reminds us, when fundamentals persist but price lags, patience becomes the real edge.
Which don't reflect the price on a percentage basis, and they look really steep. They look like a massive bubble. But I mean, the chart of gold monthly going back to 1970, yes, it's taken off since the beginning of well, actually 2024. And yeah, it's really taken off in 2025 and 6. But if you look at what it did in the 70s, we're not even like we haven't even matched what the price did in the 70s. And I don't discount the fact that we need corrections. I even said about a month or 6 weeks ago, when gold was like taking off, when it broke 4,400, and it was trading around 48, that I thought we could go pretty much nonstop to around 53, 54, and that we could see a correction. And I guess we did. But I think, yeah, the bankers, they used it as an excuse to smack it even more. But yeah, the reason I think it's going to be different this time is that the fundamentals are still there. The debt is still there. The leverage in the financial system is still there. Geopolitically, we just saw China announce this weekend, Xi Jinping, that they really want to push their currency as the major reserve currency.
The real deception here isn't the correction itself. It's how charts are used to make long-term trends look like speculative bubbles. As Mario Innecco has warned, linear charts exaggerate fear while hiding percentage-based context, and that matters when gold is still below its 1970s inflation-adjusted trajectory. Gold moving sharply in 2024 to 2026 looks dramatic, but debt to GDP is far worse today, leverage is higher, and global monetary trust is weaker than in the 1970s. Banks-driven sell-offs often follow technical breakouts because liquidity hunts stop losses, not fundamentals. China openly signaling reserve currency ambition adds geopolitical pressure. The headlines barely connect. What comes next, as he hints, may redefine how investors read corrections entirely.
So that's a challenge to the dollar. We're seeing even allies of the United States not very happy with the treatment that President Trump is serving them, right? And they don't want to be also as dependent on the dollar. So, yeah. And I don't really see any way out. People are talking about Warsh. I don't know if you want to go into him now, that he's going to be like Paul Volcker. And I think that's complete baloney, to be honest. because Paul Volcker, he he let rates go to 20%, I think the discount rate. And at the time, though, the debt to GDP was 35%. And you had a really bad recession in 1980, and then another one in 81. It was like a double dip. And Jimmy Carter lost the election in 1980 because of that. So if Warsh is going to be tough and wind down the balance sheet, and I've heard people say that, oh, he's going to help Main Street, not Wall Street. But I don't see how he can do both. I mean, there is one thing that he could do to help Main Street, and that would only be like a sugar rush, temporary sugar rush. And that would be to revalue the statutory price of gold, like from 42.22 to around where we're now. And
the Volcker comparison sounds reassuring, but the math quietly proves it's a fantasy. As Mario Innecco has pointed out, Volcker's 20% rates worked because US debt to GDP sat near 35%, not over 120% as it is today. A modern replay would detonate housing, equities, and treasury markets simultaneously, which is why balance sheet tightening and rate cuts are being discussed in the same breath. Revaluing gold would create a temporary liquidity boost, but it doesn't fix structural deficits or global dollar fatigue. Investors should recognize the difference between policy theater and solvency repair. Next, as Mario notes, the political limits of tough talk policy become impossible to ignore.
And I've calculated that the Treasury would get a $1.2 trillion windfall. They could use that to buy back some of the I think 4 trillion or so that the Fed owns of treasuries. They could do that, and then send some of it as well. Send a check to the people at the bottom who are suffering, and then they might, do well in November this year, the election. But if you look at what he said, he thinks rates should be down to around 2 or 3 or 4%, 2 or 3. So he sees room for rate cuts. So I'm not sure how he wants to do quantitative tightening. I mean, that's the opposite of loosening policy.
This is where policy contradictions stop being academic and start hitting portfolios. As Mario Innecco has emphasized, you cannot cut rates to 2 to 3% while claiming commitment to quantitative tightening without destabilizing credibility. A $1.2 trillion accounting windfall sounds powerful, but it's a one-time maneuver against a multi-decade debt problem. Sending checks may ease short-term pain, yet it risks reigniting inflation just as markets price in easing. Long-term investors should watch bond yields and liquidity signals, not election season promises.